Welcome to the Quilla Quarterly Market Update. I'm Andrew Connors, and today I also have Matthew Jeremy here with me today, and he's going to answer some of the tough questions on markets. So let's jump straight in to the first question. Matthew, there's a lot going on in the world at the moment with the trade war and Brexit. How do you see this impacting financial markets?
There is indeed a lot going on at the moment, Andrew. Let's start with some of the key economic developments. We mustn't forget that the developments in late 2018, when the Fed was tightening and China was undergoing a quite sharp and significant slowdown, these events were a major disinflationary shock that's still rolling through the global economy. Of course, the trade dispute between China and the US hasn't helped, but we also think that there's been insufficient policy stimulus, both fiscal and monetary policy around the world, in light of that disturbance late last year. Something that's particularly caught our eye is that we may be approaching a cyclical upturn in the US unemployment rate. That's important because it's usually associated with equities starting to underperform bonds. The Fed at the same time has indicated they don't want to cut again unless the data suggests that it's necessary. That worries us because by then it may be too late. Next, if we have a look at some of the geopolitical developments around the world, starting with political uncertainty, not just in the US and the UK, which are some of the most prominent with the election and with Brexit, but also within Europe, particularly Spain and Italy, and through to South America, where there's significant turmoil in a number of countries. And then, of course, there's the ongoing troubles in Hong Kong. With the relationship between the US and China, there's optimism at the moment that the signing of the so-called Phase 1 deal will be a step forward, and it would indeed be good news. But we mustn't forget that that's just the tip of a much bigger iceberg of strategic realignment between the US and China that's going to take a number of years to sort out. This uncertainty and more difficult environment on the political side constrains fiscal policy at a time when monetary policy is nearing the limits of its ability to contribute. Final point to note in geopolitics, Andrew, is developments in the primary nominations for the US Democratic Party. Joe Biden's standing in the polls has slipped, and some of the stronger left-wing candidates like Elizabeth Warren are making a surge. If these candidates were in fact to get the nomination and have a crack at the presidency, it would potentially unsettle markets because some of their policies are not market-friendly.
Thanks, Matthew. Equity markets have been performing well this year. How much further do you think they can go from here?
This is one of the key questions at the moment, Andrew. And equity markets indeed have had a good 2019. Despite some of the uncertainties and the ups and downs, we've seen new highs in the US and Australian markets, and a number of them are up over 20%. Even some of those laggard markets, like Japan and the emerging markets, are starting to catch up. But the question we have to ask ourselves is how much further can this go? And to help answer that question, we can look at both valuation and some profit issues. Let's start with valuation. Now, the chart here shows the blue line is the PE ratio in the Australian equity market on the left-hand side. The red line is the Australian cash rate, which is on the right-hand side of the chart, and it's turned upside down to highlight the relationship between the two series. So as the red line's going up, the cash rate's going down. Now, we know that the Reserve Bank's been cutting the cash rate again. It's down to 0.75% at this stage. We wouldn't be surprised to see them take it to 0.5% early in the new year. And this has supported a re-rating of the valuation of the domestic equity market. We've seen similar things overseas. The question now, though, is what happens from here, because there's not a lot more room for interest rates to be reduced, and therefore the attention has to focus on profit growth. So, for example, if we have a look at the US, this chart shows in the blue line the year-on-year real earnings per share growth in the US equity market. The red line on the right-hand side is an indicator of manufacturing activity. As you can see, the two lines mirror each other pretty closely. So the message here is that as the US economy has slowed down under the impact of those economic forces we talked about a moment ago, so the rate of profit growth has slowed down. As we look forward into the coming year, we don't see a lot of scope for either of these measures to increase a great deal. The markets currently think that the signing of the Phase 1 trade agreement would lift growth up into 2020, and indeed it might do so, but we don't believe at this stage that it will be enough to generate some sustained profit growth in the coming year.
Matthew, what strategies do you think the Reserve Bank can employ to further support the economy?
The Reserve Bank's been quite clear about its objective of getting the unemployment rate down towards around 4.5%. It estimates that that's the level that's required to generate wage growth and to push inflation up towards its objectives. In order to push this along, the bank, as we just said, has cut the cash rate to 0.75 and is likely to cut it again. A key reason that they're doing this is they want the Australian dollar to be weaker rather than stronger in order to boost our international competitiveness. As you can see from the chart here, the blue line on the left-hand side is the Australian dollar over the last couple of years, and the red line is the difference between bond yields in this country and the US. The Australian dollar has depreciated quite substantially over the last couple of years, but seems to be bottoming out at the moment. The interest rate cuts the bank has made so far have contributed to the decline in the currency, but if there's not a lot more room to go, what else can they do? When we say not a lot more room to go, yes, they might take it to 0.5%. The bank's been pretty clear that they don't like the idea of negative interest rates, and we believe them on that. Negative interest rates in Europe have proved to be a mixed blessing, and the bank here isn't keen to follow that path. However, what we do expect is that they would intervene in both the domestic currency and domestic bond markets in order to inject liquidity and keep the Australian dollar down.
Thanks for that insight, Matthew. So in summary, we anticipate slower growth to fuel muted returns from equities, but we're cautious because we think risks are elevated in the coming year, especially if the unemployment rate deteriorates further from here. As a result, a more defensive posture in portfolios with lower equity exposure is warranted with this outlook. Thank you.